With me here at our panel is Tang, the Chief Financial Officer of RioCan REIT. We have Peter Sweeney, the Chief Financial Officer of SmartCentres REIT. And finally, we have Bradley Weismiller, Head of Capital Markets at Brookfield Property Group. So to start things off, the Canadian property market has been booming with demand for warehouses and offices, and commercial property investment actually reached record heights in the second quarter of this year. REITs have also had a fairly strong performance this year, but there are headwinds that the industry is facing amid rising interest rates, trade tensions, and a relatively volatile Canadian dollar. So today we're going to be exploring what the outlook is for REITs in the market and what to expect moving forward. So to kick things off, Bradley, I'm going to hand over the first question to you. Interest rates are rising across the board, and we're set for another hike in Canada this month. How much do you think rising rates impact investor appetite for real estate in the country?
Thank you. Look, it's a very good question, and I think oftentimes people generalize interest rates, and we should make the distinction that there's the short end of the curve and the long end of the curve. And I think, from our perspective at the short end is going up for all the right reasons. I mean, we should be happy about the fact that there's a macro backdrop that supports a higher interest rate environment at the short end. And at the long end, I wouldn't exactly say that a 250 Canadian 10-year or a 3% U.S. 10-year is necessarily high. Clearly, they've moved higher. But from our perspective, we do expect rates to continue moving higher. But I do think you have to ask yourself, will that change this sort of fundamental backdrop of rates being low-ish and real estate being a compelling asset class as an alternative to long-term fixed-rate investments? And from our perspective, at 250 and 3%, we don't see that. And for another 50 or 100 basis points, I don't think you see that either.
Peter, what are your thoughts on this?
Well, thanks, Natalie, very much, and good morning, everyone. I think at SmartCentres REIT, so we're primarily, at least for now, a retail-oriented REIT in Canada. We have a balance sheet that approximates about $10 billion, and our overall debt leverage is about 44%, 80% of which is fixed, and the remaining 20% or so is floating. And so from our perspective, and I think it's fair to say most Canadian REITs would fall into the same category, we've been predicting now for several years a rising rate environment, and perhaps we've had a bit of a holiday since quantitative easing sort of subsided a couple of years back. So it's fair to say most Canadian REITs, I think, have predicted a rising rate environment. Most of us have had the opportunity over the last several years to lock long on mortgage financing or unsecured financing where it was appropriate. And so it's not unexpected that we're now in a sort of a rising rate environment. Bradley's right. The 10-year rates in Canada, at least currently by historical standards, are still demonstrably lower than they've been at least for the last 50 years. And so it's still, I think, very much an ebullient environment for borrowers, corporate borrowers. The challenge, obviously, is Canadian real estate continues to be expensive by perhaps comparative standards. And so it's very difficult these days to find acquisitions that are accretive. And so I think that continues to be a challenge for most Canadian public companies where your cost of capital is moving forward, and unfortunately, the returns that you're generating from newly acquired properties seem to be at least static because there continues to be a strong demand for quality-based properties in Canada.
I think, Natalie, part of your question beyond how real estate companies or REITs handling our own financing between unsecured versus secured, short-term or long-term, the other part of the question, I assume, is also relating to how investors value real estate, given that interest rate obviously is rising. From what we can see, it really depends on what kind of real estate you talk about, and also which cities, which market. So despite a rising interest rate and the expectation of continuous rising interest rate, we actually haven't seen the negative impact on the cap rate in major markets. For secondary market, we start seeing a little bit impact, but not significant yet. But over the longer term, if interest continue to go up, we do think it could affect the secondary market assets valuation.
And do you see
it's funny. I'm just going to interrupt. She's right. We would have expected that also in 2013 with quantitative easing being introduced, and in fact, I think most REITs at the time expected cap rates to climb and values to diminish. And since then, in fact, for the last 5 years, we haven't seen that, notwithstanding the expectation that rates were going to rise at some point. So there continues to be strong demand.
And what do you see moving forward? Do you see rates continuing to rise? And at what point do you think it'll cross that threshold where it actually starts impacting the valuation of the assets? Bradley?
Yeah, well, I mean, I think that's what policymakers are struggling with most. And you've seen, the few fits and starts over the last 5 years where there is a feedback loop of higher rates at the long end impacting asset prices all the way through, the capital markets. And so, look, I think frankly, it's the policymakers' biggest challenge. How do they raise rates in an environment where the market is predicting higher rates, but how do they do that without necessarily inducing that feedback loop for asset prices? But I do think, at 250 and 3%, the market for these types of assets can withstand at least another 50 to 100 basis points.
So let's talk about the risk management for your projects. I mean, obviously, these rising rates have an impact on construction costs specifically. We've seen costs rise a lot in Canada and affect a lot of developments. How are you guys managing that risk? Chi?
Well, it certainly we have to be very careful. No doubt construction cost is rising. So we really manage that construction or development risk multiple ways. One is, of course, we use staggered development. We don't, even though we have a large pipeline, for example, RioCan, we have about 26 million square feet extra density identified, and almost 50% is already zoned. So theoretically, we could start faster, but we have to manage that exposure. So we want to limit development to roughly around 10% of our total assets and stagger the development. So that's one aspect. Another aspect, of course, is managing that risk around the construction cost itself, because we typically pre-tender all the work, at least 80%. Tender, so we know, and we do detailed drawings. We know what the cost it is, make sure we have proper, cost consulting, and so we're building proper pro forma estimate on that cost. And so we don't proceed until we have this detailed drawing and detailed cost. So that helps us manage the construction costs. And of course, for us, another beauty is that because RioCan has a long history, we have lots of assets, many are very well located, but these are actually, even though they have development potential, but it's income producing properties. So in a way, we could afford to wait if the market construction cost is too high. So we do evaluate when we evaluate each project economics. Another aspect, as you where we use strategic partnerships, really deal with, depending on the market, which local, we partner with the right partners in the local market to take advantage of their local expertise, but also, of course, to reduce the cost exposure and the risk exposure on our end. So really multiple ways to manage that development risk. A final aspect I'll add is we do limit our condominium exposures, because condos, as you know, you tend to pre-sell early. But if in a construction cost rising environment, you pre-sell early, and so your margin as the costs go up may not be as strong. So that's why in Toronto you start seeing people, especially private developer, canceling some of the condo projects. So we want to limit that exposure, manage that construction cost as well.
Peter, what are your thoughts on this?
Yeah, I would echo Chi's sentiments. There's obviously a strong desire on the part of most developers to fix hard costs to the maximum degree possible, to fix interest rate costs on construction projects when it's appropriate. Obviously, top lines are sometimes frozen if you're selling condos or townhouses. And the one variable we're finding and we're not alone, this is, I think, something that's ubiquitous in development is time. So the one element that you often can't control in a development cycle is the cradle-to-grave time requirement to get from start to finish. And so development companies that have been around a while do one other thing. They allow for substantive contingencies in their budgets, whether that relates to interest or hard costs or soft costs or any of the above factors. Even the top line, there's a contingency factor against. So notwithstanding that in most markets, you're always going to have pressure on cost escalations of all types, developers of consequence and perhaps of experience are always going to have substantive and sufficient contingencies that will offset any of these escalating costs. And so I think it's fair to say when you're looking at projects, and the types of projects we're talking about are not 6 to 12-month projects. They're often 5 to 10 years or longer projects. And so you're typically going to go through at least one, often two economic cycles in the project's cradle-to-grave lifetime. And so it's important in those pro formas that you allow for some of the unknowns, and one of those unknowns one of the unknowns is interest rates. So I think it's fair to say any of the larger companies that are doing development in Canada, at least, are establishing large contingencies for the unknowns.
There's definitely a lot of appetite heating up for multifamily properties, especially in Toronto and Vancouver, as rents are soaring. What are your prospects for growth in that market? How long do you see rents continuing to rise in that market? And is now the time to develop all this, especially as a lot of your competitors are doing the same thing and costs are rising at the same time? Bradley, what are your thoughts on prospects for the apartment sector?
Yeah, well, I mean, I think you have to go back to to the comment about contingency there, right? And if interest rates are rising for the right reasons, and to your point about soaring rents, it means that the cash flows are rising as well. So I wouldn't exactly describe necessarily a lot of this as speculative or undue. But look, I mean, the macro fundamentals seem to be there at the moment. No doubt that rates have been increasing, rental rates, and so. Look, I think if you're underwriting cap rate compression in this type of an environment as an underpinning for the return, that's probably a little bit dangerous given where we are in the cycle. But if you're in an asset class with shorter duration cash flows where you believe you can grow those cash flows, I think it's fair to assume that a lot of those returns are still there.
And Peter and Chi, are you guys actively putting more and more apartment residential buildings in your development pipeline for this year and the next few years moving forward, given this environment that we're in?
I think it's fair to say we are, and I suspect, Chi, you would have the same answer. So in Canada, at least among the REITs, it's difficult to do an extraordinary level or amount of condominium or townhouse construction just because of some of the limitations that we have domestically for tax purposes. Having said that, it's fair to say that for many of the larger REITs in Canada, a disproportionate amount of growth is being generated these days from condominium and or townhouse development. And so I know at SmartCentres, we're currently under construction with our first 3 55-story towers in Vaughan. And we're getting set, I think it's fair to say, to introduce the next 2 phases early next year. There was a point in time in Toronto's history, and frankly, in the world's history, where demand for condominium housing or any types of housing was very, very much curtailed because of the absence of job growth, the absence of immigration, and just a general malaise in the economy. And at least to someone like myself, it doesn't seem like that long ago. So what are the mitigating factors that as a developer or a partner in a condo development you have to ensure you do to mitigate that downstream risk? One of them is to sell as many of those units as you can, but as Chi mentioned earlier, one of the challenges you have when you do that is you lock in your revenue line in a rising cost or escalating cost environment. And so the best way to mitigate that is to find a way to condense and compress the timeline to go from cradle to grave. And so at least for us, one of the critical factors in our decision making was to identify a partner that had sort of that same expectation on the importance of being efficient in the time cycle to go from start to finish. And we're happy to say that at least for the condo projects that we have currently for sale, that we're well ahead of schedule. So I think it's fair to say, at least these days in this environment where you do have escalating costs, you do have perhaps some level of trepidation on your top line because of the queasiness and the concerns around whether we've sort of hit the top of the market or not, that it's important to really find ways of chiseling back on that timeline for completion.
You're also all fairly invested in the retail space, and I'm interested to see what your outlook is for the retail market, especially in America. Everyone's saying retail is dead. In Canada, it's doing a little better, but what are your thoughts on retail? Bradley, from Brookfield, I mean, what do you see for that market?
Yeah, absolutely. Look, obviously, we've been very active in the space publicly and privately, and I think you're right that in the U.S., it's getting a lot of headlines. I think the big distinction is that the U.S. is over-retailed. On a per square foot per capita basis, the U.S. has substantially more retail than other markets, and so we would see that expressing itself more as a bifurcation. The good stuff will continue to perform well, and that was really the underpinning of our rationale with the GGP transaction is that that was, substantially a Class A portfolio of malls. The good stuff should continue to perform well, and the weak stuff, probably needs to be repurposed. But I think as a general trend, we're fairly comfortable with it. We think retail has has a future. The right retail will continue to perform well, and the best retail is performing incredibly well for the same reasons that we were describing before, with the macro backdrop favoring consumer spending. So we see it as a complement to the online developments.
And with the legalization of marijuana happening in Canada this month, supposed to be happening, I mean, what's your outlook for the impact of the weed market on retail in Canada?
Well, it's a hot topic, no doubt. It's a little bit hard to, estimate, to be honest, because the largest market, Ontario, the regulations, there's still quite some uncertainties. And we certainly have quite some of those, providers approaching us and about stores. And so, I mean, it's something we will deal with. But until the regulation really basically come out and clarify, it's actually hard to write those leases at this stage. But in Alberta, for example, because the regulation is more clear, and so we've already written some leases, but it's still a very small portion of our total portfolio.
Peter, what are your thoughts?
Yeah, well, I have a couple of thoughts. With respect to the marijuana situation in Canada, for those who don't know, marijuana is being legalized nationally in Canada later this month in some of the provinces, particularly Ontario. I think will take some extra time to get it legalized in those respective provinces. But the point is, over the near term, the scent of marijuana will be something that becomes quite pervasive in most Canadian cities. So you don't have to go to Amsterdam anymore to enjoy that. So I think as real estate people, we have to find a way to embrace it, probably not unlike many real estate companies may have done back in the 30s in the United States when prohibition was abolished. So there would have been, a strong sentiment against the abolishment of prohibition back in the 30s in the United States, and at some point, people got over it. I suspect the same will be true in Canada. But, going back, Natalie, to your earlier question on retail in Canada, I think it's fair to say, and I think Brad's point was the right one, there is a bifurcation and there is a clear distinction between how retail is managed and received in Canada versus the United States. There hasn't been in Canada, at least, an overbuilding of retail space over the last 4 decades. Notwithstanding the experience of Target and notwithstanding that Sears Canada closed its doors earlier this year. Those two events have resulted in what we'll say is an oversupply of, at least for now, available inventory in the marketplace, but that's temporary, as opposed to there having been an overbuilding of real estate historically in the country. And so, having said that, it's fair to say that most Canadian retailers with bricks and mortar, so to speak, continue to do well. And by the way, that doesn't mean that they're ignoring the emergence of e-commerce and omni-channel type initiatives by most large and medium-sized retailers. Canadians embrace that, but I think it's fair to say also that Canadians have been a little slower to digest the whole e-commerce penetration. We seem to like to go to our bricks and mortar locations. SmartCentres REIT, for example, we have a predominance of Walmart anchored shopping centers in our portfolio. They represent about 40% of our space. And we built the portfolio that way to withstand any sort of economic attack. So in Canada, there's no stigma, so to speak, associated with shopping in a Walmart store. And Canadians embrace sort of discount or value-based shopping in all markets and economic climates. So, to your earlier question, Natalie, I think it's fair to say, at least in Canada, the retail world continues to thrive. I know our unit prices don't necessarily reflect that, where we're trading currently a little below NAV for most retail REITs in Canada. That would suggest that people like Chi and I would very much like your support to find ways to improve those NAV prices. But from a business perspective, our businesses continue to thrive. We continue to enjoy some leasing and occupancy success. We continue to find growth in FFO. And we continue to find ways to continue to grow both our balance sheets and our P&Ls over time.
Bradley, any thoughts on your end about the marijuana market and growth opportunities there?
Well, look, the overwhelming majority of our retail exposure is in the United States, and it's a different, it's a different backdrop there. It's still a federal crime, despite what's happening in certain states.
We'll be looking forward to a lot more U.S. visitors up to Canada in the coming years.
So yesterday we were talking about the end of the credit cycle and where we're at now, and how is it different from 10 years ago? What are your thoughts on that, Bradley?
Yeah, look, it's a great question, and I think to compare it to 10 years ago, you do have to sort of look at the financing structures, and I would say there's probably two things that encourage me and one thing that concerns me. The two things that encourage me are, one, the leverage levels just generally are a lot lower than they were at the last time. You're seeing discipline from the banks. You're seeing discipline from some of the rating agencies and the securitization type structures. It's just all happening at a lower leverage point. And the second is that spreads still are quite a bit wider than they were 10 years ago. I realize they have tightened quite a bit over the last few years, and you would describe this as a relatively tight credit spread environment. But relative to 10 years ago, I think spreads are still there, so it's not, we have certainly not gotten anywhere close to those levels. The thing that concerns me though a little bit is that the all-in fixed rate is quite low, and so the solution to a lot of sort of hiccups in the economy since the 1980s has been just to bring down everybody's all-in cost of financing. And from Peter's point about REITs having had the benefit of lowering their coupons, they have, and it's tremendously accretive to the equity, but it raises the question, what happens next time? And it doesn't matter whether it's spread or benchmark rate, there's a coupon. And if you can't refinance that debt at the same low coupon or a lower coupon, are we setting ourselves up for a longer period of slower growth? I don't know, but I would say that the all-in coupons is one thing to keep an eye on.
We have about a minute left. One last question directed towards you, Chi. What would you say the markets are getting wrong about REITs and about the credit markets that we're in at this point?
I think certainly as a retail REITs, number one for us is, as Peter mentioned, is that the misperception about the retail REITs, right? Canadian retail is very different, so it's not really reflected in the valuation. And also all the REITs, quite a number of REITs, maybe not all, are diversifying themselves into a mixed-use development, into residential and some office, like in our case. So that development pipeline in terms of the REITs valuation is certainly not reflected in the current trading price as well. So on the interest rate, of course, the general rising interest rate environment is always not considered favorably for REITs. I think the investor do have to look at on a company by company specific, see how company manage their risk, their interest rate exposures in terms of that debt maturity ladder, in terms of the variable rate exposure. So you have to take all those things into consideration, instead of just a big brush and saying rising interest rate is bad for REITs. Yeah.
Thank you. I think we've reached the end of our panel. Just want to thank our panelists again for joining us today. Thanks everyone for attending.